gentlemen, if you could just start by giving us an overview of where we are in the Miami condo market in terms of financing. We've heard that banks have retreated. We've heard that things are a lot harder than they used to be a couple of years ago to secure money for new projects, for acquisitions, for refinancing. Can you just give us a little sort of high-level picture of where we are? Ezra, let's start with you.
That's a very big subject to talk about. So I think you have to segment the conversation into a couple of levels. Number one, about the construction financing, which gives rise to the buildings. That's going to be a serious problem in the near future. Banks are reluctant to make loans in to-be-built condos, first because of the market conditions, but just as importantly because of the new regulatory environment that they are subjected to. So that means that nearly 50% of the lenders that were out there in the last 10 years are effectively out of business, or their criteria for making loans is very difficult to meet. Then there are the private lenders who are really the other 50% today, and that's a whole different subject. Then there is also the issue of end loans for your buyers, and I believe that most of the people here are in the residential world. I think they're going to find it probably somewhat difficult to source end loans, particularly if you're not a resident of the U.S., and particularly if this is a non-residential use. In other words, you're not moving into this unit and you're looking to use it as an investment vehicle. I think you're going to find mortgages to be very difficult from a banker's point of view. There are a lot, if not many, private lenders out there today and many more coming in to the market. I think they're going to be substituting for the banks, but they're going to be higher rates. They're going to be lower loan to cost. So it's going to put some pressure on the condo market.
Brent, any thoughts to add to that?
Yeah, thanks. So our firm, Bloomfield Capital, doesn't focus on large deals, large developments. We're $1 to $15 million. So the projects that we're getting requests for today are typically more infill, smaller projects. They may be, call it $5 to $20 million type condo developments. And so we're seeing exactly what Ezra said, is that the banks don't want to lend on these projects. They don't want to put the capital in for the infrastructure. Banks will lend oftentimes on the development of the actual, the ground up piece, but when they're preparing the land and getting ready for development, the banks just don't want to touch that. So that's one piece of the business that we're seeing a lot of. And then the other side of the business is buyers that are looking to acquire assets, end buyers, and getting a conventional mortgage if you are a U.S. citizen is very difficult, and getting a second home type of property if you are not a U.S. citizen is extremely difficult. And so we think that, again, that there's going to be opportunities for private lenders like our firm to step in and make those loans as the banks retreat.
Daniel, if they've said all this, how do you guys keep busy? Because it seems like it's a little bit more challenging now.
So, well, Ezra's definitely correct that the construction finance is certainly going to be a problem in the very near future. Some of the local banks down here still have a small appetite, I would say, for some construction. Condos a little more difficult right now, but maybe a townhome type condo with certain requirements, as Ezra pointed out, that are difficult to meet, but achievable by certain lenders. I mean, first and foremost, the loan to cost, the LTC, when it used to be maybe at the beginning of the cycle closer to 65% LTC. Now we're seeing it dialed back closer to 50, 55% LTC, which is certainly a challenge. Of course, you still need the 50% pre-sales, and almost, primarily driven by the story and the seasoning of the developer. The local banks here really have to believe and get behind the developers and know their experience and be comfortable with their experience to really be able to go forward with the construction financing and, of course, with the recourse. So it's still out there. It's difficult. It certainly is, but we keep busy with those types of projects.
Brent, so banks have somewhat retreated from this space, but that void is being filled by alternative lenders, private equity money, hedge funds. Could you just explain the thinking there and what they're looking for? What sort of opportunities are those lenders seeing?
Yeah, firms like ours are typically focused on the collateral, not as much on the borrower themselves. And I'd say the number one thing that we look for in deals when we're doing our initial due diligence is what's the exit strategy. A private lender like our firm would typically be in a deal for anywhere from 6 to 24 months. And so we're not going to be with the borrower for a long period of time. So our capital has to make sense to help the borrower take advantage of a good opportunity that typically needs to close in under 30 days, which I would say is a typical closing timeline for a private lender. But ultimately, the private lender like us doesn't want to end up with the real estate. We want to see the borrower end up paying us off. And so the first question that I ask, and almost all of our deals come through brokers, so the first question I ask the broker is, how are you going to get us out of this deal in 6 to 24 months? And if there's a good answer to that, then we'll continue. And if it's, hey, we'll figure it out in 6 to 24 months, but we have no idea, then it's probably a project that we would pass on.
So there are plenty of brokers out here today. What sort of strategies or advice would you give them to be able to give your firm a more educated answer so the deal doesn't really get broken off? Sometimes it's just a question of lack of knowledge, or the broker might, this is all French to me. I don't understand this. But what can they do to really get you to where you need to go as a lender?
Yeah, I think that brokers that can kind of pre-qualify a borrower, and again, I don't need a commitment letter from another lender, but a broker that brings us a deal and says, I've done my vetting of this borrower, I understand that he or she will be able to get financing once XYZ happens, and can kind of lay out a roadmap to me. And again, we can figure that out. We look at a lot of deals. We look at 200 or 300 deals a month, and so we can get there. But if a broker can lay that out in advance, that certainly gets the process moving much quicker. And our goal at our firm is to really be able to give an answer quickly, because most of our deals, again, they close fast. And so most people will not come to my firm we're a higher rate lender than a traditional bank. And so they're not going to come to me first. Typically, they're going to come to me second or third. Doesn't mean it's a bad deal. It just means that they were walking down the path with a lender that was conventional. And at the nth hour, that conventional lender said, we can't do the deal. And just as a quick example, we're working on a deal right now in Colorado, and it's a ground-up development for condos, very similar to what you would see in South Florida. And I got a call yesterday from my borrower who said, I've raised my $4.5 million worth of equity. We're set to close in 3 weeks. The bank is all ready to go with a $5 million construction loan, but they want $1 million worth of cash collateral in the bank to do this deal. And they sprung it on me the day of the loan committee, and they don't have an extra $1 million. So that type of process with conventional lenders is what keeps shops like ours in business.
Ezra, can we just track back a little bit? And you mentioned regulation. That's sort of having banks take a second look at these, somewhat retreat from the market a little bit. What specific regulations are we talking? Commercial banks, big banks aren't making the kind of loans they used to. They're not being as aggressive as they used to.
Look, we're getting into a very sophisticated time in the lending side of the business. When everything was going right, underwriting was simple, you checked out the borrower, pre-sales were going strong. Many of you out there were selling units like hotcakes. People were lined up. We're in a different world today, and the world has changed dramatically. It not only has changed dramatically for those who are involved in selling residential units, and not only for the developers of residential units, but for the lenders as well. And the lenders really run the show. So we're talking about, when you're talking about banking industry, banks, regulated banks, that means they're FDIC insured, that when they are being told by the regulators that you can't make these loans, or if you do, it's going to be classified, which means that they have to then support that loan with assets that they weren't planning on doing. They're not going to make the loan. So we're into a world where banks are only going to make loans to very special people, special developers. And when I talk about special developers, I'm talking about developers with a lot of experience, a lot of cash in the bank, liquidity, and a great track record. And even then, it's difficult. So what's happening, to your question, is that we're seeing a lot of private equity funds forming lending platforms. You name them, I can give you the A to Z of all of them, and they're all coming into the market. They've been in the market, but they are expanding by tenfold, and they're going to basically make a loan, or they're going to underwrite a loan very differently than a bank will. They're going to require more equity than has been required in the past. They're going to charge more for those loans than has been required, which by definition means that less loans are going to be made, number one. Number two, we have a market condition that's going to make it very difficult to underwrite. And that means that, before we were underwriting, units at $2,000 to $3,000 a square foot on the beach, who knows, $500 to $1,000 a square foot in the urban core. Those numbers are all changing. And until and when borrowers, residential brokers, developers, landowners make the transition mentally that we are in a different world, we're going to have what I call this in-between time where people are just beginning to understand that things have really changed. So I am telling everyone that comes to us, and we have a lot of friends who are borrowers. I'm a lender, on top of which we are brokers. We lend money directly to developers. The world has changed, and you better come to terms with it.
There's actually a very stark example of that from the last panel where we had, some of the top brokers in the city here, and they were saying everything is great. You're able to get construction financing quite a bit. Someone mentioned if you hold out, you could sell condos for $5,000 a foot, Miami Beach. So that disconnect that you're talking about is very real. And I'm wondering, if you guys want to jump in here, does the developer, okay, if the brokers are, optimists by nature, and that's a great thing, but does the developer understand that the world is different?
Yeah, I think that one of the things that we look for up front with the developer on a project that has a development component is, does the developer believe in their own deal? And I think that's really important. And it sounds kind of silly to say, but a lot of times we'll get deals and people will bring them to us and say, well, what do you think? And I'll say, well, what do you think? Tell me if this deal is going to pencil out. And we still see.
This mortgage broker that I was talking to, he said, I always ask my developers a question. Tell me one thing that is special about this project apart from the fact that you're doing it. And I think that that's something that comes up as well.
Yeah, and so I think that people are oftentimes looking they're looking backward at this point, and then they're adding 5 or 10%. And I think people have been doing that for the last 5 years. And in the last 5 years in Miami, condo prices have been going up. And then this year they haven't. And there's starting to be more product on the market. And people have reached out into areas that may not be main and main. They may be main and second. And so as long as people can continue to get mortgages and capital can continue to flow, those deals will get taken. They will get absorbed at some level. But at a certain point, as Ezra pointed out, the banks can only lend a certain amount, and the regulators are clamping down on these banks, and they don't want them to put more money into condo developments. There's new capital requirements that have come in as part of Basel III, where they have to reserve additional capital if they're lending on certain types of development projects, and so people are they're cautious. The lenders are cautious, and
I'm just curious to see who's sitting out there. How many of you are residential brokers?
Good chunk. How many commercial brokers?
Commercial brokers?
And
mortgage brokers? Mortgage brokers?
Just the one brave soul there.
Mortgage brokers?
And how many people are looking for a loan at this point? Developers, small developers? Okay, I see a few. Thanks for doing that. Yeah, absolutely. So Daniel, if the construction condo market has slowed down, some people may not know it yet, but it has slowed down. What parts of the market, which asset classes are still thriving? You still see plenty of debt coming in. Any thoughts on that?
Well, sure. Just to jump off their point, firstly, it's certainly the condo financing for all the issues that have been raised is certainly difficult, the ground-up condos. But it's really not just the condos that are going to be facing very tough financing hurdles in the very near future. There was somewhat new development in the CMBS market, the commercial mortgage-backed security market, that's going to be rolled out in the end of December. That's the risk retention.
I have to talk a little bit.
What's that?
Yeah, that's better.
Yeah. The risk retention regulation that's being imposed on CMBS lenders, which, just to give you a little bit of a background, back before the crash, which of course was a different world, about, I think 60%, if I'm correct, of loans, commercial real estate loans, were done through commercial CMBS shops. last year it's about 17% of all loans. This year it's down to 7%. And now with these new regulations in place, it's certainly going to push that number down even further. And the way the new regulations are working is now they're being required to hold on, the CMBS lenders are being required to hold on to 5% of the deals for 5 years after they sell off the B piece of the deal to other investors, which is certainly going to make the CMBS lenders much more picky about their deals. They're going to have to, vet the underwriting much more thoroughly, and it's certainly going to cause them to slow down on their lending. So it's not just the condo market, but the commercial real estate lending is certainly, it's going to be interesting in the very near future.
I just want to add something for those of you in the residential mortgage, sales world. There's some good news here. And the good news is that if there's going to be a slowdown in the development of condominium buildings, it's going to give rise to less of an inventory coming onto the market and could at least help to those who are going to be closing, because I'm looking for stability somewhere. And the stability will come when we have less of velocity of development. When you're seeing a high-rise condo being announced every week, that's good. It sounds great, and it's a source of business for all of you. But when you have 50 high-rises being announced, that's not good. So I think the slowdown in the production side, which means construction, is going to give a great deal of help to those who are, first of all, closing units, and it'll create a tighter market in terms of the bid and the ask for existing units. So my hope, and I may be wrong on this one, is that we'll see less inventory on the market in the coming years, thus creating a more balanced market. I hope I'm not being a little too sophisticated or over. I'm trying to explain that we need to slow down.
It's a very hard, bitter pill for brokers to swallow, but I think there is a lot of sense there. Right.
It'll create activity, but good activity. It doesn't do you any good if you're selling a unit, and a lot of you get paid up front for that, I know that. But if you sell a unit, it doesn't close, or it closes and you have a bad situation, it reflects badly on everybody. You want a positive environment for everyone. And I hope that with a slowdown in the production side, we're going to see that.
Brent, we, in Miami, obviously in South Florida at large, foreign buyers make up a big percentage of the market, especially the luxury market. They're a driving force in many cases. You were talking a little bit about your experiences working with your company with foreign buyers and how you have to sometimes step in at the last moment to help them over the line. Can you just flesh that out for the audience here?
Yeah, we've made loans to borrowers from all over the world that are buying assets in the United States. We only lend in the United States. And for us, again, we're asset-based lenders, and so we're focused on the real estate. So we're okay with that, and we're all right making loans to borrowers. And again, we've made them from about half a dozen different countries. A lot of times borrowers will start down the road with a mortgage banker that says, yeah, I can get this done for you on the commercial side or on the higher end residential side, and then get kind of, again, through some sort of committee process depending on the size of the loan, and then they're just, well, we need this or we need that or we need you to have X amount of capital in the United States. And a lot of the buyers that have already put down large deposits on assets, for example, on new high-rise condos, the whole reason that they're taking out a loan here is because they don't want to have to bring capital into this country. And
are you seeing anyone walk away from those deposits, even 25, 30%? They said, look, I can't come up with the money. I've got to let this go. Have you seen that happen at all?
I haven't seen that yet. I don't know if Ezra's seen that happen or Daniel's seen that.
What we've seen is where someone comes to us literally 10 days before closing and say, I don't have the money. And it's not once or twice. I'm talking about a dozen times. And in some cases, we were able to execute. In other cases, it's just impossible. But we're seeing more troubled situations than before.
Okay, question for you. I'm a mid-sized condo developer. I have somewhat of a track record, but I'm not a Related or someone like that. I'm not a blue chip, long track record developer. I want to do a 25-unit condo, asking an average of, let's say, $600 a foot. How do I go about getting my money? And you can play with the numbers. It's just a
Start with
hypothetical.
50% equity.
Okay. If I don't have 50% equity, what other avenues do I have?
Stop.
But I've got the land. I don't know what to do. But guys, any thoughts on mid-sized condo developers and what strategies that they may have?
Yeah, I agree. I think that in this marketplace, there's, especially for smaller deals and the deals that we focus on, sub $15 million deals, if they don't have the equity to do the project, there doesn't make any sense for a group like ours to put a $2 or $3 million mezzanine loan or a second lien loan on that asset. And at that point, nobody wants, at this point in the cycle, I just don't see, again, on smaller projects, I'm not talking high rises, but on smaller infill projects, I don't see anybody that wants to go to 75% loan to cost or 80% loan to cost on those deals, unless there is some real value proposition, such as the borrower has owned the land for 25 years and is contributing something, but that's typically not, that's not a typical deal that we're seeing.
Daniel, you want to add to that?
Yes. In the local market, in particular for a mid-sized developer who wants to build something like you're describing, I mean, always it helps if your basis is low. If you've owned the land at a good price, that's, of course, that goes without saying, helps the financing side of things. A nice thing is that a lot of the local lenders over here are doing for smaller developers is that if they've owned the land for, let's say 10 years or so, they'll actually consider the market value instead of the book value when they do the calculation of the loan to cost formulation, which certainly will help a developer who's kind of just saw an opportunity 10 years ago, sat on the land and waited for the right time. There's still a market out there. Again, it's tough, but there's still a market out there for a guy like that to go with a local bank. And again, he'll be going 50% loan to cost, maybe 60% in some cases. He's going to have to sign recourse, and he's going to have a good story and a good experience track record. But it's still, they could still go to those traditional types.
You mentioned smaller banks. So we saw Wells Fargo said, before the scandal hit, they said, we're going to do less lending in 2017. That's obviously going to be true now after the scandal. B of A's pulled back a little bit. But we've seen Bank of the Ozarks, for example, come into the market in a very aggressive way in New York, also in South Florida. Are you seeing other banks kind of filling that void? Just banks, maybe smaller ones, who are not subject to the same regulation?
Well, again, I want to say this very clearly. There's plenty of money, and there are plenty of lenders out there. It's just the criteria for making those loans has changed. And the transition, as I said earlier, is between the regulated banks versus the private banks. And the regulated banks are probably going to be much more difficult to deal with in terms of their requirements. But the private bankers, the private lenders are not a pushover. Bank of the Ozarks has been very, very active here in New York, which means they're not going to be, they may be running out of money soon, okay? I don't have any inside information, but we know them well. There's only so much you can do and put on your books before you start getting scrutinized very, very carefully by the regulators. Now, and that, by the way, applies to also non-regulated bankers, which is private equity funds. Although they're not regulated, they have other, that regulated from the standpoint of federal regulations, they have other regulations to deal with. It comes down to two things. First, borrower. Second is the quality of the project. And the quality of the project means if you underwrite it correctly based on today's information, not yesterday's, today's information, and if the project is profitable, chances are you'll find a lender. And that profit means a minimum margin of 30% against gross sales, minimum. Now I'm getting into the weeds, but that's the kind of stuff that lenders are looking at today. And that's what I'm looking at.
Brent, the 50% deposit has been touted as a safeguard that Miami didn't have in the last cycle. The brokers are saying that, look, now we're taking 50%. They're taking 50% deposits. They're going to get their money. The projects are going to happen. But we've seen some projects where that's being relaxed a little bit. So you're seeing someone maybe right at the finish line, but in some cases well before the finish line as well, where they're saying, okay, we'll take 20% or 25%. Do you see that as becoming sort of an ongoing trend, or do you see the 50% deposit becoming sort of a permanent fixture of the Miami market?
Yeah, I don't know if it will become permanent or not, but I don't when you're dealing, especially with foreign buyers that are bringing their capital into this country, it doesn't matter. I mean, it's costing double for some people to close on a deal what they thought it was going to cost, 18 months ago when they put down a hard deposit. And we continue to see, I don't know if it's going to be required for the borrowers, but the developers may require it, because as the banks continue to tighten up on their lending, that's now becoming a big source of capital for these projects, and it's really backfilling the equity on development deals. And so I don't know in the near term how that drops down, especially with the banks that are funding these deals pulling back.
But if the foreign market dries up, then those sort of all-cash deals or the cash-rich buyers may also dry up, correct? So I think a lot of that deposit structure is because they could rely on the foreign market, the foreign buyers. That's slowing down a little bit.
I mean, I think that there's a lot of cash, as we said, there's a lot of cash sitting around waiting to do deals, and I think that when you see some blips, you're going to start to see some smart money come in and start to buy stuff at a discount, take it quickly, and there's a lot of liquidity out there, so the market should stabilize. I mean, I don't think that you're going to see another 2007, 8, 9, where the whole financial market shut down. But then again, there's a lot less lenders out there. There's a lot less, a lot of these small CMBS shops are shutting down. A lot of the small banks don't have real estate departments the way that they did the last go around, and so you're seeing more capital coming from a few large sources. And if those sources have hiccups, that may create some issues. So I don't have a great answer on that.
Got it. Any thoughts on the construction financing market for rental housing, rental assets?
Obviously, it's much easier space to talk about, but other than Miami, we have actually looked very carefully at the Miami rental market to be built. And if you just look at the market from, let's call it Coconut Grove to Mimo, so it'll be, let's call it 79th Street, east of I-95. I think the last time, Howard, we looked at it, we're announced and or ready to go, 11,000 rental apartment units. That's astounding, astounding. Now, that doesn't mean that we're going to see 11,000, but that is what has been announced, okay? Clearly, the market is much more open to making loans on rental apartment projects than on to-be-sold condominium projects. And frankly, the market was high as 80% on cost of rental apartment projects at the peak of the market. Today, I would dare say that you're going to probably look at no more than 70%.
That's still pretty high.
And going south, it'll probably be stable at around 65% loan to cost. But I am very concerned about the number of projects that have either been announced or have broken ground or about to break ground, which leads me to believe that of those announced, I would dare say that 25 to 30% will not break ground.
In that current form, in that iteration, or just period?
In the area I just described.
Mm-hmm. Brent, any thoughts on rental housing, the market financing? And then I want to open it up to questions in a minute, but go ahead.
Yeah, I think what we've seen over the last couple of years, just nationwide, not just in South Florida, but is that folks were developing apartment buildings for multifamily rental housing, and they were developing at 7.5% cash on cost, and then it was 7%, then it was 6.5%, and then over the last probably 18 months, I'd say go back 12 months ago, we started seeing deals in strong markets like in South Florida or in Dallas or in strong Midwestern markets where it's a 5.5% or a 5.7% cash on cost for just regular apartments because folks are depending on going out and getting a HUD loan for 40 years and low interest rates. And so what we found is that the financing was driving the development deals. And so that got scary because if you couldn't get that HUD loan for multifamily, your deal just doesn't work. You're halfway into your deal, you're halfway into development, and if you haven't got that perm HUD loan, you're stuck. And for the next 10 years, you're underwater.
You guys are a pretty pessimistic bunch, I have to say. After all the optimism for 4 hours, it's quite interesting to have you. But I appreciate that. Daniel, and then this is the last question. I want to open it up. But what is the biggest opportunity right now as a debt broker in this market? What sort of, where would you go? And let's stick to South Florida, but what sort of assets do you find have the most promise?
As a mortgage broker, you're asking? I mean, the easy answer that I'm sure everyone would agree to on this panel is the multifamily, for sure. I mean, the money that's being deployed to lend on multifamily right now is still very, very strong, whether it's local banks, which are getting almost as competitive as agency lending, but not quite, like the Fannie Mae, the Freddie Macs. But there's still very strong deals out there where they're offering you low interest rates. Sometimes they'll go up to 75% LTV, sometimes to 80% LTV. Loan to value, and they're offering interest-only periods. So for multifamily, so there's still a strong market there. How long that lasts, we'll see. But right now, I think that's certainly an arena that there's a lot of activity in.
Ezra, your 2 cents?
Look, the reason rental apartment buildings are still in play is because of one word. It's called liquidity. There's always a buyer for a rental apartment building. And I mean that individually, and I mean that institutionally. The institutional investors, be they pension funds, insurance companies, are all over the market, and also private purchasers. Rental apartment buildings are still the favorite of the entire real estate market in terms of liquidity. You can buy it, you can finance it, you can do whatever you can, except when you start getting into a market where there's just way overbuilt conditions. So that's my only pause.
Please join me in thanking our panelists. Thank you so much.